Hey everybody, David Safransky, Financial Revelations. Chair Powell had a press conference today and the Fed raised rates a quarter point, 25 basis points. You know, it was expected, as I told you, they were going to raise this month. It was baked in the cake. It was going to happen. It was a done deal. And that's exactly what happened. Now, they did remove some language from their statement that they give about the next meeting that made it a little bit more likely that they take a pause in June. My prediction right now is that they're not going to pause in June. They're going to raise rates in June because the data is still going to be hot. Now, the data is getting a little bit better. Inflation is off of its peaks. That's true. But employment is still at 3.7%. That we can't do that. And, you know, I love Elizabeth Warren. Senator Elizabeth Warren was on TV, and she's saying, Chair Powell wants people out of work. Well, Chair Powell doesn't want people out of work. But when you flooded the market with money, like the Democrats have done, and they'll continue to do if you let them, and you have all these open jobs, we have a lot of open jobs, it creates inflation. It's inflationary. The more money you have in the system chasing fewer goods, the more inflation you're going to have. And so he does want to create a little bit of slack in the labor market, but he doesn't want people out of work. I mean, we would love 0% unemployment. If that and it probably is possible if you take out all the people that are unhirable for whatever reason. You know, maybe they're in the hospital or in prison, something like that. It's hard to hire somebody who's in prison, although they make license plates. But let's say that you didn't count those people. If we had the oil fields open, if we had the gas fields open, if we were back to the Trump economy, is it possible that you could have 0%? Well, I suppose it's possible. Is it probable? Probably not. But the other thing, too, that's happening is the market is now betting that there's going to be rate cuts this year. And I got to tell you right now, there are going to be no rate cuts this year. There are not going to be rate cuts this year. The Fed really does want to see us in a mild recession to slow things down. And these guys aren't, if you remember the late 70s, we had rampant inflation. The fuel prices were skyrocketing. We had an oil embargo. Jimmy Carter had stupid people working for him. He's a nice man, but he had some really poor economic theorists working for him, and they made a lot of mistakes. And kind of that's what the administration is doing now. The Fed would like to see us in a shallow recession. They're not going to channel their inner Paul Volcker and go to 15%, which Paul Volcker would have done, by the way. He would have done that. He would have raised rates way before this Fed did, and he would have been way stronger about it, even though these guys were the fastest in history. They did those 75 basis point rate hikes. Paul Volcker never did that, but Paul Volcker never stopped. He kept going and going and going, and I think he probably would have done that. He probably wouldn't have taken out the language that they did in today's meeting to say, well, we're going to be more data dependent, kind of throwing a bone to the market, which I don't think they're going to be able to meet. So there are no rate cuts coming this year. There is a recession coming this year. I think that the recession could be soft, but it's going to be a recession. And now the June rate hike is going to happen, in my humble opinion. Now, I could be wrong. We could get to June and it not happen, but I think I'm right. And the Fed also says that a recession is less likely than likely, but I don't know. Their toolbox is recession. In the end, when they you open up a toolbox and there's all these screwdrivers and some of them are like 100 years old. You got a wood handle one. You start taking stuff out. At the bottom of your toolbox is the tool you need. For the Fed, it's recession. And that's what's going to happen. Now, when they raise rates, like they did today, it does make the banking crisis a little bit worse. And just this past weekend, First Republic went out of business. They went into receivership. Now, it's funny because, it's not funny, but First Republic Bank was known in the banking industry as a really solid bank. They didn't make bad loans. They didn't get caught, making a bad investment and losing money. And they had some of the wealthiest depositors around. California Bank. The problem was that people wanted their money back, and they had to sell their bonds at a loss to create money for the depositors that wanted their money back. So higher rates make the bank issues a little bit worse, because now bonds are starting to get more attractive again. When the banking crisis first started, rates got depressed. So you get a 6-month treasury. This is a guaranteed treasury at the equivalent of a 5% annual yield. Well, you're not getting that in the savings account. So people are pulling their money out of savings accounts, and they're going into the government bond market. So banks live on deposits. So here's what happens with the bank. You deposit your money in a bank. They don't put it in the vault. They loan it to somebody. They do a home loan, a car loan, school loan, a personal loan, home equity loan. But that's how banks make money. They get loaned out. And a bank wants to be as loaned out as they possibly can within certain parameters. So they're like, well, I don't want to put 100% of my loans in homes, so I'm going to do some car loans and some other loans. So they have a kind of like a portfolio of loans that they have, and it's a lot like your stock portfolio, like your investment portfolio. They have some money over here and some money over here, and if they get too much money in home loans, then they'll say, well, let's not do any home loans for a while. Let's do these loans to diversify. That's how banks make money. So that's when people go to rob a bank, they're like, oh, I'm going to get all this money. You get like $1,500 and go to jail for 10 years. Would you go to jail for 10 years for $1,500? I hope the answer is no. So they don't keep money in their vault. And the Fed says to them, the Federal Reserve says, okay, that's great. We want you to be loaned out, but you got to keep a certain amount of money on deposit at the Fed overnight in case there's a run on the banks. And the Fed has lowered that required limit over the years to get banks loaned out and profitable. Now there's a run on the banks a little bit, and information moves so fast. So if I tweet out, hey, I just went to my bank and I couldn't get my money out, 1,000 people are going to read that. They're all going to go to the bank and try and get their money out. Now we have a run. And that's what's happening to some of these banks. A big depositor goes in. They can't get their money. They tell somebody who then tries to get their money, the run has started. It only takes a few people with $100 million to sink a small bank. And that's what happened to First Republic. That's what happened to Silicon Valley Bank. I think the banking situation is not over. So the big banks, the large banks like Bank of America, JP Morgan, all those guys, those big guys, Wells Fargo, they're going to get bigger. JP Morgan they were awarded really First Republic's assets. It was a sweetheart deal. It allowed them to have more money on deposit that's insured than what the government generally allows. The big banks are going to get bigger. I think they're good investments because they're going to be taking in assets. I love the big banks. I have for a long time. And bonds are looking attractive again. When the banking crisis first started, rates came down. I couldn't buy a bond for a little while. Rates have kind of percolated back up, slowly. And now with the rate hike, I was watching the yield curve short term, 6 months, 5 months, 4 months. I bought some July, some June bonds today. I bought a couple of corporate bonds. But they're starting to be more attractive. We should be looking at those things. You don't have to be 100% in the stock market. For a long time, you did if you wanted to get anything. Because if you bought a 10-year government bond, you got 1%. And that's what happened to the banks. So don't be the banks. Don't buy a 10-year government bond right now. If you're going to buy a longer-term bond, I would buy a corporate, higher grade, or depending on what your risk tolerance is. And that's whenever you buy something in the market, whether it be a bond or a stock or a mutual fund or an ETF or a REIT, we got to assess your risk. How much risk are you willing to take? And there's no need to bet the farm right now. You don't have to do those things. I don't like to bet the farm. I don't bet the farm with my own money, so I wouldn't do it with yours. So June, I think a rate hike is coming. Rates will be a little bit higher. And then I think they probably stop. I think we're getting very close to the end. And that's when you want to buy bonds, is at the height of the interest rate cycle. Because if they do lower sometime next year, those bonds are going to be profitable. That's how I look at the bond market. That's how you might want to look at the bond market. Talk to your people. You got people, right? I got people. You got people. I'm David Safransky, a real American, true red-blooded patriot and the voice you can trust.